Hi, I'm Steve Harris, Safe Money Steve at Harris Retirement Advisors. I started a new video series explaining the different types of annuities available today and why people buy them for retirement planning. Today, we'll focus on what's called Multi-Year Guarantee Annuities, or MYGAs. You see, many of us see today's market losses and volatility and wonder, where can I put my money today, where it's safe, where I can stop the bleeding and earn something on my money? The recent interest rate increases by the Fed tends to increase most fixed rate instruments, including annuities, so rates are up. In fact, interest rates on MYGAs have almost doubled in the past year, and as of today are coming close to 5% a year. Now, these two factors have increased consumer awareness of MYGAs, and maybe why you're watching this video now. So over the next few minutes, I'll explain what MYGAs are, why people buy them, and the 6 key factors to consider if you're thinking about buying one. Now, because I've spent most of the past 30 years in executive level positions for 3 major life insurance companies, designing annuities, creating suitability standards for buying them, and training thousands of advisors on annuities and where they might fit in a portfolio, I bet you'll likely hear something you've never heard before. So what is a MYGA? A MYGA is a fixed deferred annuity issued by a life insurance company. Multi-year means the interest rate's guaranteed for more than 1 year. Guaranteed means it offers a fixed interest rate for the initial term and a guaranteed minimum interest rate if you decide to renew it at a subsequent term. An annuity means it's a policy issued by a life insurance company authorized to do business in your state and by that state's Department of Insurance. We'll talk more about life insurance companies a little bit later. Probably the best way to describe MYGAs is to compare them with something we're already familiar with, and that's a certificate of deposit issued by a bank, a bank CD. And just like a CD, a MYGA offers a guaranteed interest rate for a specific term. And just like a CD, at the end of the term, you can take your money or you can roll it into a new term at the current interest rate at that time. And just like a CD, there are safeguards in place to protect your money. And that's where they start to differ. You see, the money you provide for a CD issued by a bank or a credit union is protected by a quasi-federal agency. For banks, it's called the Federal Deposit Insurance Corporation, or the FDIC. The standard insurance amount provided by the FDIC is $250,000 per depositor per insured bank for each type of ownership. Now, money used to purchase an annuity is protected by the claims paying ability of the insurance company and something called the State Guarantee Association in each state. The standard amount covered is also $250,000 per annuity in most states, including Georgia. Just send me a note below if you're outside of Georgia, and I'll be happy to tell you what it is in your state. So how are MYGAs different from bank CDs? The most obvious difference is the interest rate credited. You see, annuities often credit interest rates that are 2 or 3 times higher than a bank CD. Now, why is that? Now, most of us have noticed that long-term interest rate terms typically pay a higher interest than short-term interest rate terms. Insurance companies buy investments to deal with long-term time horizons, like providing a life insurance death benefit on an event that might not occur for 40 years or guaranteeing an income stream for one's lifetime. We see banks often deal with shorter time horizons, like money going in and out of checking accounts and money market accounts. Their longest obligation is often a 30-year mortgage. So the general account at a life insurance company can typically earn higher interest than the interest rates that a bank can charge on their loans. So insurance companies are able to credit higher interest rates. I think that's enough about interest rates for now, but we'll touch on that again a little bit later. A second important difference is access to your money. The penalty for canceling a CD at a bank is often loss of interest, but not the principal. We'll talk more about liquidity in annuities as part of the 6 factors to consider when considering an annuity purchase. Now, another important difference between a MYGA and a bank CD is tax treatment. Now, if you have IRA money in a bank CD, the earnings receive tax deferral, not because it's a CD, but because of IRA money funding the CD. But after tax money, the money that you earned and you have left over after paying tax on it, that money in a bank CD does not receive tax deferral, and taxes are due on any interest earned the year the interest is earned, even if it's a multi-year CD. So even if you don't spend the interest, you and the IRS will receive a 1099 for the bank on the interest earned, even if you didn't withdraw the money. Now, the tax treatment is different with an annuity. You see, only annuities issued by life insurance companies can earn tax-deferred interest on any money used to buy an annuity, whether it's IRA dollars or after-tax dollars. What this means is that annuities have what's called triple compounding on earnings, and here's how. First, the initial deposit, called the premium, earns interest at the stated interest rate. Because of compound interest, you also can earn interest on the interest that's already been credited. But now you can also earn interest on what you would have paid in taxes, giving you more money when you do withdraw it and possibly pay taxes at a lower tax rate. So tax deferral gives you the ability to decide when to pay taxes. Now, Steve, how can I do that? Everybody knows that tax day is usually April 15th. Well, you see, you only pay tax of an annuity when you withdraw the money. If you don't withdraw the interest, you don't pay any tax. And I've seen how benefits of tax deferral have helped people pay less on their Social Security benefits just by moving money from CDs to annuities. Send me a note below if you want to know more about how to do that. Okay, so let me share with you one more benefit before we move on to why people buy them. If you look up the definition of annuity, it would say an annuity is a fixed amount of money that you'll get each year for the rest of your life, meaning a series of systematic payments. So most annuities, except those specifically called immediate annuities, are actually called deferred annuities, meaning that payments can start at a later date, called annuitization. And in the meantime, the money inside the annuity policy grows tax deferred. Now, while I don't see many MYGAs being annuitized, all deferred annuities offer the ability to convert the policy to an income stream that you can never outlive. To learn more about immediate annuities, check out my immediate annuity playlist on my YouTube channel. So we just covered what a MYGA is and how they differ from bank CDs. Now let's look at why people would buy them.